بسم الله الرحمن الرحيم. السلام عليكم ورحمة الله وبركاته. This video is concerned with illustration of the first chapter in this course of cost accounting, which is the manager and management accounting. The main concern of this chapter is to introduce the five-step decision process utilized by managers to make a variety of decisions. These 5 steps include: firstly, identifying the problem and uncertainties; secondly, obtaining information; thirdly, making predictions about the future; fourthly, making decisions by choosing among alternatives; and finally, implementing the decision. With the emphasis on the 5-step decision process, material relating to the problem solving, scorekeeping, and attention directing roles of the management accountant are streamlined. There is also an increased emphasis on the linkage between the set of business functions in the value chain and customer expectations as key success factors. You will find that this is an important chapter because it provides a foundation for studying subsequent chapters. Learning objectives. Concerning the learning objectives of this chapter, you should, after studying this chapter, be able to distinguish financial accounting from management accounting, understand how management accountants affect strategic decisions, describe the set of business functions in the value chain, and identify the dimensions of performance that customers are expecting of companies. Explain the 5-step decision-making process and its role in management accounting. Describe 3 guidelines which management accountants follow in supporting managers. Understand how management accounting fits into an organization's structure. Excuse me. Understand what professional ethics mean to management accountants. Now, let us discuss each one of these learning objectives in more detail. Concerning the first learning objective, which is distinguishing financial accounting from managerial accounting, you must have learned through studying previous accounting courses that accounting systems are information systems. They process economic events and transactions into information helpful in decision making. Accounting is concerned with providing both financial and non-financial information that will help decision makers to make good decisions. An understanding of accounting, therefore, requires an understanding of the decision-making process and an awareness of the users of accounting information. We begin by looking at the users of accounting information, identifying their requirements, and distinguish between management accounting and financial accounting. Users of accounting information. Accounting is a language that communicates financial and non-financial information to people who have an interest in an organization, such as managers, shareholders, and potential investors, employees, creditors, and the government. Managers require information that will assist them in their decision-making and control activities. For example, information is needed on the estimated selling prices, costs, demand, competitive position, and profitability of various products that are made by an organization. Shareholders require information on the value of their investment and the income that is derived from their shareholding. Employees require information on the ability of the firm to meet wage demands and avoid redundancies. Creditors and the providers of loan capital require information on a firm's ability to meet its financial obligations. Government agencies like the Central Statistical Office collect accounting information and require such information as the details of sales activity, profits, investments, stocks, dividends paid, the proportion of profits absorbed by taxation, and so on. In addition, the tax authorities need information on the amount of profits that are subject to taxation. All this information is important for determining policies to manage a country's economy. You should know that accounting information is not confined to business organizations. Accounting information about individuals is also important and is used by other individuals. For example, credit will only be extended to an individual after the prospective borrower has furnished a reasonable accounting of his or her private financial affairs. Non-profit making organizations such as religion organizations, clubs, and government units such as local authorities also require accounting information for decision making and for reporting the results of their activities. For example, local authorities need information on the costs of undertaking specific activities so that decisions can be made as to which activities will be undertaken and the resources that must be raised to finance them. The foregoing discussion has indicated that there are many users of accounting information who require information for decision making. The objective of accounting is to provide sufficient information to meet the needs of the various users at the lowest possible costs. Obviously, the benefit derived from using an information system for decision making must be greater than the cost of operating the system. As it is shown in the following diagram, users of accounting information may be classified into two groups: external users and internal users. As for external users, they are such as investors, government, banks, suppliers, lenders, and the like. But as for internal users, such as sales managers, distribution managers, manufacturing managers, and the like, since information needed to be provided to external parties is different from that needed and used by managers, So the integrated accounting systems in an organization should consist of two subsystems, which are financial accounting and managerial accounting. Financial accounting has a historical focus, as it reports the results of operations to external parties. These reports must adhere to generally accepted accounting principles. But in managerial accounting, the managerial accounting reports financial and non-financial information that helps managers make decisions that will help the company achieve its strategy. So it is forward-looking. Information is reported in a manner that will help managers do their jobs better and are not restricted by generally accepted accounting principles. Cost accounting. Cost accounting measures, analyzes, and reports financial and non-financial information related to the costs of acquiring or using resources in an organization. Cost accounting is an important component of each of financial and managerial accounting. Why? Because cost accounting involves determining the cost of something such as a product, service, an activity, a project, or some other cost object. These costs are needed for several purposes. For example, the costs of products and services produced and sold are needed for both tax and external financial statements. In other words, tax and financial accounting depend on cost accounting to provide cost information. Information about costs is also needed for a variety of management decisions. For example, cost estimates are needed to determine whether or not a product or service can be produced and sold at a profit. Unit costs of a product or service are also needed for product pricing and product discontinuance decisions. In addition, accurate cost information is required to determine whether or not a company should make, produce, or buy the raw materials, parts, and sub-assemblies that become part of its major products and services. From this perspective, cost accounting is perhaps underrated. From this perspective, cost accounting is perhaps underrated as a discipline, since none of the other disciplines, including financial accounting or managerial accounting, could exist without cost accounting. It is important to know that the emphasis of cost accounting has changed. Prior to 1950, cost accounting courses emphasized generating cost information for tax and financial accounting purposes. These courses had a fairly narrow orientation towards inventory valuation for external reporting. However, in 1950, a textbook by William Butter placed more emphasis on the internal user of accounting information rather than the external user. After 1960, most cost accounting textbooks had a distinctive managerial decision orientation. Vatter's work was definitely a turning point. Two other very influential books, although they are not textbooks, were published in 1987 and 1988. These works include Relevance Lost, The Rise and Fall of Management Accounting by Thomas Johnson and Robert Kaplan, and Cost Management for Today's Advanced Manufacturing, edited by Callier Berliner and James Princeton. These two books represent another turning point for management accounting. Both publications sharply criticize traditional accounting and propose substantial changes in internal accounting systems. These important publications introduced the concepts of cost management, activity management, and investment management that have become important components of management accounting. However, today, most accounting professionals take the position that cost information is part of management accounting. Therefore, the distinction between the two is not clear-cut, and in this course, we often use the terms interchangeably. Excuse me. Now, let us see the major differences between managerial and financial accounting. As for the purpose of information, in management accounting, it is to help managers make decisions to fulfill an organization's goals. But in financial accounting, it is to communicate organizations' financial position to investors, banks, regulators, and other outside parties. Primary users. In managerial accounting, they are managers of the organization. But in financial accounting, they are external users such as banks, investors, regulators, and suppliers. Focus and emphasize. In management accounting, it is future-oriented because budget for 2017 is prepared in 2016, but in financial accounting, it is past-oriented because reports on 2016 performance were prepared in 2017. Rules of measurement and reporting. In management accounting, internal measures and reports do not have to follow generally accepted accounting principles, but are based on cost-benefit analysis. But in financial accounting, financial statements must be prepared in accordance with generally accepted accounting principles and be certified by external independent auditors. Time span and time of reports. In management accounting, it varies from hourly information to 15 to 20 years, with financial and non-financial reports on products, departments, and strategies. But in financial accounting, annual and quarterly financial reports primarily on the company as a whole. Behavioral implications. In management accounting, it is designed to influence the behavior of managers and other employees. But in financial accounting, it primarily reports economic events but also influence behavior. Managers' compensation is often based on reported financial results. Excuse me. Now, you may want to test your understanding through the following sample of questions and exercises. First question: management accounting. What it does? Focuses on estimating future revenues, costs, and other measures to forecast activities and their results, or provides information about the company as a whole, or reports information that has occurred in the past that is verifiable and reliable, or provides information that is generally available only on a quarterly or annual basis. It is clear that the correct answer is choice number A. Second question: managers use management accounting information to do what? Help external users such as investors, banks, regulators, and suppliers, or communicate, develop, and implement strategies, or communicate a firm's financial position to investors, banks, regulators, and other outside parties. Ensure that financial statements are consistent with the SEC rules. It is obvious that the correct answer is number B. Question number 3. Financial accounting. Focus on the future and includes activities such as preparing next year's operating budget, or must comply with generally accepted accounting principles, or is the process of measuring, analyzing, and reporting financial and non-financial information related to the costs of acquiring or using resources in an organization, or is prepared for the use of department heads and other employees. It is clear that the right or correct answer is number B. Question number 4. The primary user of financial accounting information is factory shift supervisor, distribution manager, current shareholder, department manager. It is clear that the correct answer is number C. Question number 5. The primary user of management accounting information is a or an the controller, a shareholder evaluating a stock investment, bondholder, external regulator. It is clear that the right answer is number A. Question number 6. Financial accounting provides the primary source of information for decision making in the finishing department, improving customer service, preparing the income statement for shareholders, planning next year's operating budget. The right answer is number C. Which of the following is true of management accounting information? It focuses on documenting past business actions of a firm. It is prepared based on SEC rules and FASB accounting principles. It is prepared for shareholders. It coordinates product design, production, and marketing decisions. The right answer is number D. Question number 8. Which of the following statements refers to management accounting information? There are no regulations governing the reports. The reports are generally delayed and historical. The audience tends to be stockholders, creditors, and tax authorities. It primarily measures managers' compensation on reported financial results. The right answer is number A. Question number 9. Which of the following groups would be least likely to receive detailed management accounting reports? Stockholders, or sales managers, or production supervisors, or distribution managers? It is clear that the right answer is number A. Question number 10. Management accounting information typically includes tabulated results of customer satisfaction surveys, the cost of producing a product, the percentage of units produced that are defective. All of these answers are correct. It is clear that all of these answers are correct. Question number 11. Cost accounting measures the costs of acquiring or using resources in an organization, helps managers to develop, communicate, and implement strategies, coordinates product design, production, and marketing decisions, and evaluates a company's performance, communicates information to investors, banks, regulators, and other outside parties. It is clear that the right answer is number A. Question number 12. Which of the following differentiates cost accounting and financial accounting? The primary users of cost accounting are the investors, whereas the primary users of financial accounting are the managers. Cost accounting deals with product design, production, and marketing strategies, whereas financial accounting deals mainly with pricing of the products. Cost accounting measures only the financial information related to the costs of acquiring fixed assets in an organization, whereas financial accounting measures financial and non-financial information of a company's business transactions. Cost accounting measures information related to the costs of acquiring or using resources in an organization, whereas financial accounting measures a financial position of a company to investors, banks, and external parties. The correct answer is number D. Question number 13. Which of the following is true of financial account information? It is prepared based on cost-benefit analysis. It is primarily used by managers to make internal business decisions. It focuses on the past-oriented financial performance of a company. It only measures the cash transactions of a company. The right question is number C. At the end, I would like to thank you.